Folks, risk management. It's really important. I know most of you are interested in entries, technical indicators, market analysis, but you know what? Without risk management, none of that matters. In today's video, I'm going to talk about stop losses, where to place your stop loss, how to place your stop loss, and what the best type of stop loss is. Let's get into it in today's video. Stop losses can help you stay in control of your trades and limit your losses. Without stops, you can devastate your financial and mental capital in the blink of an eye. Don't let it happen to you. Check out this video first, then click the button below to learn how to trade even smarter and to lower your risk and increase gains. You've got to learn this. All right, let's talk about stop losses. Why does it matter? Why are they important? Why are we talking about them right now? Well, markets are choppy. There's a lot of factors moving on. China, tariff wars. One day we're on, one day we're off. The bottom line is, till they're resolved, we're going to see a lot of volatility. So right now, more than ever, stop losses are really important. So there's two types of stop losses you need to know about. There's a fixed stop and a variable stop. And I'm going to talk about both of them today. A fixed stop is really simple. You buy a stock, it doesn't matter what stock it is. You buy a stock at $100 a share. You put a stop loss at 90. No matter where the stock goes, the stop loss remains at 90. That's a fixed stop. A variable stop is very different. A variable stop is a stop that you move. So let's say we take a stop and we move it and we keep it 10% away from the stock price. So for example, we buy the same stock at $100 a share. We put the stop loss at 90. The stock goes up to 150. We keep the stop loss now 15 points away. So we keep the stop loss 10% away based on the value of the stock. So as the price of the stock moves higher, the stop loss will continue trailing the stop. And it's good if you do that if you're expecting a really long-term move and or you're expecting the stock to move substantially. Here's the problem with variable stop losses. Variable stop losses are unrealistic when it comes to short-term trading, and I'll tell you why. The shorter the time you allow the stock, you give a stock, or it doesn't matter. We could be talking about Forex, currencies, futures, commodities, or stocks. It doesn't matter. Everything I'm saying applies to all of the above. So let's say that we're trading and we're using a stop loss, a variable stop loss, but we only are holding a position for 2 weeks. Well, how far do you think a position can go in 2 weeks? Not very far. So if you're holding a position for a short period of time, it's unrealistic to use variable or movable stops. It's much better to just allow your position to move and give it a little room to breathe. So if I'm swing trading, I like to use a fixed stop. If I'm trading a position and I'm expecting it to move 9 months or a year, then I would use variable stops, or maybe even 3 months to 6 months. But a few weeks, don't use movable stops, because what will happen is you'll end up moving your stop too quickly or too close to your position, and you'll get stopped out. Now, another kind of stop is a time stop. And a time stop is really cool, all right? Because what a time stop does is it allows your position, it gives your position a specific period of time. And if your stock or commodity or futures contract or Forex contract or option doesn't do what you want it to do within that specified period of time, you would just liquidate the position. That's a great way to manage positions because you're not allowing the market makers to take you out by lowering the position, tapping your stop, and then seeing the position rise. So again, there's 3 types of stops. There's a fixed stop, there's a variable stop, and there's a time stop. And the one you use depends on what you're trying to achieve. I would not use a time stop unless you have a built-in hedge. So if you have a portfolio and it has a gold position or a bond position, some type of a natural hedge, that's when a time stop works well. If you don't have a natural hedge in your portfolio, and if you're trading a single position or just 2 positions, then it's dangerous to have a time stop, because what if something bad happens and you don't have a natural hedge? Let's say you have a bond and you have a stock, If you have both and the stock market tanks, bonds spike or gold spikes. But if you don't have a natural hedge, it's too risky. So don't use a time stop unless you have a natural hedge in your portfolio. If you're trading short term, best thing to do is use a fixed stop. And if you're trading longer term, 4 months, 6 months, 9 months, a variable stop is a great idea. So again, the stop loss you use has to match the strategy or the type of strategy you use. Don't just say, oh, I like this type of stop loss, I'm going to use it just because it feels good to me. It doesn't work that way, okay? Stop losses have to match your strategy. Swing trading, fixed stop. Position trading, variable stop. Volatility is really high, fixed stop. Volatility is low, variable stop. You want to give your positions a little room to breathe. Now, let me give you a little bonus, okay? How do you measure your stop? Use the actual underlying volatility. So if the stock or whatever asset you're trading is moving from high to low over the last week, say $5, give yourself $10, double it. Take your 2-week volatility and double it and use that as your stop. That way you're using the market's actual volatility as a guide in setting your stops. Again, ATR is the name of the filter. It's called ATR filter, ATR indicator. It's not really an indicator. All it does is take the highs and lows of the range and averages it. But that's a great tool to use to measure volatility. ATR indicator, actual true range. Hope it helps. So, are you struggling with your stop losses and keep finding yourself letting stocks control you than rather the other way around? Not good. Click the button below to learn how I've combined my automated trading expertise with Rob Booker's currency market brilliance to create a totally new system that takes the guesswork out of everything to help score the biggest profits in the shortest amount of time with the least amount of risk. Click the button below. Entries limited. Don't miss out. Do it now.